Hey everybody, and welcome back to another video. Sorry for the brief hiatus. I had quite a bit of trouble with Loom once again, but we are back and running once again. And wow, look at here. Quite the green day in the market. Every indice is up. The S&P 500, Dow 30, the Nasdaq, and the Russell 2000. Wait, what's that you say? You got beaten up in the streets? There's blood everywhere today? What? Let's take a look at the biggest losers, because I do not think that the indices give you the biggest idea of what happened today. So if we pull up the biggest losers from Yahoo Finance, we can see just the amount of pain that went through the market today. Anytime you see a stock going down 40% in a day, whew, not a good day. Doesn't matter if many people are invested in this company or not, but got a market cap of almost $2 billion, so good amount of people were hurt in this one. We look at Fastly, was down 27%. Let's kind of see if we see any big names in here as we scroll down. Tilray, first one that pops up, down 11%, down to $14. Let's look at the stock chart on that one. Oh my goodness. Look at the year chart. The year chart didn't quite grasp quite the volatility. We can see here, just back in February, this hit a high of $63. That is quite the drastic move downwards. You do not know, Tilray operates in the adult cannabis industry. They're one of the biggest players currently. We see here, Twilio, down almost 10%. I know a lot of retail investors are in that one. Market capitalization of $52 billion. So it went down almost $5 billion today. Sheesh, what a move. What a move. If we look here on the next page, just so many different stocks down over 5%. Anytime you see this amount of pages of stocks in the red, you know that it wasn't particularly the best day in the market. For most people. Now, I'm not saying that if you were invested in the market, you couldn't make money today. I'm sure a lot of people made money if you were invested in some of the cyclicals or the industrials, emphasizing this rotation going on in the market. Uber, almost a 9% move downward today. Penn National, down 8%. But yeah, overall, just kind of, honestly, a horrible day. I don't particularly know how the Russell 2000 panned out positive today, because it was down almost, I think, 2% today at certain points, which means most stocks in the Russell 2000 are down at least double that. So hence the reason why a lot of small market cap stocks are down over 5%. But why is all of this happening? I will try to give you the ideas behind what is really going on in the market currently. There's been a lot of volatility. And although the indexes and indices aren't going down on a day-to-day basis, they might be gaining slowly. As we see here, a small gain for each of them today. Most of the retail names and a lot of the more popular stocks are just getting hit hard and hammered. So I'm going to kind of try and get into why that is happening. My biggest idea is that there has been very, very inflated numbers from a lot of these companies. And what I mean here is that these stocks have run maybe 200, 300, 400, 1,000% in some of the instances, and they just need some time to cool off. And that's no different from any stock, index, market. It's not good to go up every single day. You want some resistance when you go up. I know that's not a very common idea, but it just makes for a much better graph and more sustainable over time. If we look here in the past 5 years, just based off of, we'll look at the max for the S&P 500. But if you would have invested in the bottom or the trough of December of 2008, you would have already 6x'd your money just from putting it in the S&P 500. Basically, the most safe way you can invest in U.S. stocks. A lot of people, especially Warren Buffett and Charlie Munger, will tell you, yeah, most people, they believe aren't capable of picking out individual stocks on their own. They say, you're not smart enough, just throw it in the S&P 500, which I personally disagree with, and I think I'll be making a whole video about that. But most people will tell you just invest in the S&P 500. If you would have put $100,000 in 08, you would have over $600,000 by now. And it's no different from any of these indices. They have just been on a tear, not only for the past year since the bottom in 2020, but for the past 5 years, it has been almost straight up. We look here, 08, December of 08, if you would have invested into the Dow 30, you would have over 4x'd your money. It was about 8,000 at the same exact time. If we look at the Nasdaq's the most substantial. If we look here for the 5-year, if you would have invested at the bottom in December 08, oh, didn't mean to do that. December 08 here. Oh, max. You would have over 8x'd your money. Closer maybe to a 9, but it was down about 1.5 thousand, and now it's at 13,000. Just so much growth over the past decade and a half. Kind of to the point where it's getting almost a little bit ridiculous if you know index investing. There is an argument saying that the amount of innovation and just the amount that innovation has created to kind of help this growth has kind of propelled this growth forward, creating it exponentially. And obviously, the bigger the number is, the more it's going to grow. So over time, the bigger these indices get, the more they will grow by. But still, these are just quite substantial gains for the long term. You would have invested in the Russell 2000 at December, you would have over 4x'd your money. So that's pretty darn good. Just sit and forget, 4x your money over about a decade. Can't really complain. If we look here at crude oil, another inflationary asset, as people have been talking about. Oh, oil's been inflating. Oh, there's so much oil and inflation. This I would kind of pull back on, just based off the fact that the only reason that it did get so low in the first place was because the Saudis ramped up their production and they were producing at a loss. Not a loss, but they were forcing the United States to produce at a loss if they wanted to compete. So they can pump out a profit from about, I think, $20 a barrel, where the U.S. is closer to around $30 to $40 a barrel. So they were pumping down the profit to about $25 a barrel, and it's currently at over 60. So this is kind of misleading just based off the fact that it was artificially low, but it has gone up quite substantially. So it has inflated quite a bit. Gold I won't go into because it hasn't really gone up too much, but almost the biggest example is Bitcoin. A lot of people don't think of inflation from an assets point of view, which is what I've kind of tried to been disproving by going through the indices. But if we look here, just last year, you could have picked up Bitcoin for $6,000. Oh, 6,000. Pick up Bitcoin for 6,000. Over 10x since then. And this is not the only place that we have seen inflation. If we look here, the consumer price index, or the average price that people are paying for their goods. If we look on the chart here, all food or all items has gone up about 2.5%. Food has gone up 3.5%. Energy, like I said, the big one, oil, has gone up over 13% on a year-over-year basis. Now, that is partially misleading because of the oil and the supply, but it's just gone up more expensive. I think even if we didn't have the Saudis artificially producing it lower, if we look here, the oil chart, crude oil back in, it was about $50, so it's still gone up over 10% if we didn't have that crazy oversupply. So everything we're seeing inflating. If we look here, just in the past month at new releases, this is on the U.S. Bureau of Labor Statistics, so this is a pretty reputable source. CPI increased 0.6 for March. Now that doesn't seem very high, but times that by 12, and that number over a year-to-year basis is pretty darn high for inflation. In March, the CPI for all urban consumer rose by 0.6 seasonally adjusted basis, rising 2.6% over the last 6 months, not seasonally adjusted. So 2.6 for the year is no joke. We're seeing inflation. It's here. The real question is, will we continue to see inflation? And I will get into that later in the video. We look here. This is on Car Gurus. The average used price by I don't really care about the maker, but average used price over the past year has gone up, and it's gone up in a pretty straight line for most of these. Now there is a little bit of a dip in here, but they're going up, and that's not a small move. The average price has gone up over $1,000 for a Honda, gone up almost $2,000 for a Toyota, gone up over $5,000 for a Ford. For Chevrolet, it's gone up over almost $2,000. So these are pretty big moves if you wanted to buy a new car. Now, part of this is the chip shortage for the car industry. You may say that the consumers aren't really benefiting from chips, so why would they need to increase the price, the suppliers, to pass it on to them? Now, you may not directly benefit from the chips, but the chips are the chip shortage is causing a shortage in new cars, which is causing more demand for used cars. So used car prices are going up because the demand's going up because there's less supply of new cars, because there's less supply of chips, because China is hoarding a good amount and buying in bulk, and there's just been a lot of supply constraints with foundries, and no one can produce enough for their orders currently. And it seems like people have been saying that for almost a year now. We look here, the average used price for a new car has gone up in the past years. Just in 2019, it was $36,000, and it's almost $38,000 now, $37,800. And probably the biggest area that we have seen, excuse me, inflation is the housing market. Now, we get to the numbers, it's not too much inflation currently, but like I said, with the assets, it's just been on a tear since 2009. We look here, the average price in 2009 was just about $200,000. It's pushing 400. The housing market's doubled since the crash, which is crazy to say. If we zoom in here on the year, we'll do just the 1 year, we'll do 5 year. Just since the crash in 2020, we've gone up. It was about $320. It's gone up $40,000 per home at the peak. It's starting to cool up a little bit here, but housing prices have inflated. A good part of this is just because of demand, and also for new houses, the lumber prices has gone up quite substantially. I think we can look here. Lumber. Maybe wood. I don't know, but you can definitely track it. And if you look, the lumber prices has over tripled since the bottoms in March last year. And what does all this mean? It means, like I said, that the economy has inflated. But that's not necessarily a bad thing. The bad thing is if we continue to inflate. And there are kind of two types of inflation I want to get into. The first type is obviously commodities, anything that you're buying, such as wood, lumber, or maybe houses. But the really, really bad inflation that the economy hates to see, which is kind of bad because you almost want to see inflation in this area, is wages. If we see wage inflation and companies having to start to pay more for their employees, that is where we can see real damage in the economy. Right now, we haven't really seen any of it. People have not had to pay more money for their employees. Part of this being they're not having to go to the office and they aren't coming in and they can work from home, which is seen as a positive for a lot of people, saying that, oh, I can work from home. I don't even have to go in the office, so I don't really mind not getting a raise. I'm not maybe putting in as much effort as I am at home, or just for numerous reasons. They haven't had to pay their employees more. I do see this as a slight risk, and that the economy could start going on a downward spiral because there is quite the incentive to not work currently. Unemployment benefits are through the roof compared to average before we had any of this in, government spending trying to help out the unemployed. So I think as the reopening continues, it might, this is not a guarantee, just a thought that I'm having. I don't even know this will come to fruition, but it might be hard for companies to get people to work. Everywhere I go, I see help wanted, need more workers, but no one's getting them. I even know people that are on unemployment and are reluctant to go off because they say, why would I go back to work if I can make almost just the same amount and not have to do a darn thing? So this could be a big problem for the economy in the future. We may see more benefits for people in the new infrastructure bill. That is yet to be seen, and there might be a fourth stimulus, maybe fifth. I don't know what number we're on, so keep an eye out for that. But once the stimulus runs out, we could have a big problem with wage inflation. Now, that is where we can get some real damage. If you made it this far, give me a like, please. It helps the channel grow. Give me a subscribe and comment down below what you think. Will we see inflation in wages or just in commodities? And have a good one.